Okay, hi everybody. Good to be back. The topic: improve your trade selection with pattern and direction. I'm just excuse me. I am just truly just amazed at the true fractal nature of markets. That if you keep scrolling down the microscope, you will find trades you can take that are still in line with those higher time frames. On the lower time frames, it really just amazes me. That markets are fractal in nature. Literally, that what we teach on the higher time frames is apropos for the lower time frames, and it goes the other way too. But before we start, I need to remind you that trading is a risky endeavor and not suitable for all investors. That's for sure. It is not for everybody. People that they have a little trouble controlling themselves in a casino, or people that have a little trouble controlling themselves when they go out on the town every now and again. Trading that may not be for them. It takes a ton of discipline. It's interesting. Some of the best traders I know of started out with very little money. Why is that? How did that turn out that way? Well, it helped because they didn't. If you don't have a lot of money, you're going to be very, very cautious in learning how to trade. You're going to learn a lot of the good habits. If someone starts out trading with a lot of money and there's more behind it, they tend to learn bad habits. So I think that's why so many of your top traders on the exchanges, and even to this day, they started out with very little money. I mean, like Tudor Jones, very, very successful trader, came from a pretty well-to-do family, but he knows what it's like to get fired from your job and to go home and have your dad say, "No, you're not staying here. You don't even have a job." So he knows what it's like to start from zero, and I think a lot of traders do. So now that being said, hey, another caution here: the techniques I demonstrate are proprietary and should not be retaught or retransmitted for any reason. But my point being, back to that disclaimer, it's you have to understand the risk involved here. I think any profession that encourages the use of a demo environment, of a simulator, needs to be taken seriously. My name is Jay Norris. I've been around some. I was a 20-year trading floor veteran of the Chicago Board of Trade. I've also written a couple of books for McGraw-Hill. The tactic we're going to show you today is highlighted in the second book, Mastering Trade Selection and Management. Here's our third book. This is a great book. I wish I would have written this book first. What a book. It really shows you not only how we choose the market to trade, how we choose which market to trade, and it's so effective, but it really it gives you so much so much insight into how markets move and what traders do and how market makers view things. That it's a heavy book. We're very proud of it. Hey, let's start out with a subject that I don't normally cover with my students. We try to focus on what works. Let's cover this very quickly. Why do most retail traders not succeed? They don't understand risk. Risk it's subconscious to us. Literally, you don't have a whole lot of control over your subconscious feelings. When you act subconsciously, you have very little control over that. As a matter of fact, your subconscious is about 100 times more powerful than your conscience. Okay, taking risk. You have to understand the subconscious pull it's going to take on you. If you don't subconsciously believe that a trading method works, then you're not going to take the risks necessary to trade that method. So it's extremely important that you subconsciously believe that what you have is successful, and that takes time. That definitely takes time. That's not something that's going to happen overnight. You need to see it. You need to see success over and over again. Repetition. It's built by rote. You see the same thing happening the same time over and over again, and you have a pretty good idea that that's going to work for you more times than it's not. Then you're in a position, you understand the risk you're taking. You're willing to take those risks because that's the risk you have to take to get more money. Okay? So you just can't read a book or take a course and then be expected to get in there and do it. And that's one of the reasons why that I insist on teaching in live markets, so that the clients can get that, they could see that repetition over and over and over again, and they could see the losers, and they can process the losers, of course, also. So it goes both ways, right? But that's why you have to understand risk. And I think that book, The Secret to Trading, Risk Tolerance Threshold Theory, goes a long way in explaining the underlying causes for you to grab your mouse and exit a trade prematurely. Okay, probably the second biggest reason why people lose is because they don't understand that it's not up to them to determine that when they're going to buy and sell. It's up to the market. They need to take advantage of market-generated setups and signals. I'll give you a quick example of market-generated setup and signal. I was adjusting those lines here. The market tells me that this is these are significant levels right there, right? Let me move that up. There we go. I didn't determine that there's support right here. The market did. The market actually told me that long before price got there. Well, I did have the benefit of seeing when I came in this morning that the price had actually bottomed. Actually, that happened when I was awake. But price had bottomed once in that zone, so that tipped me off that the market's respecting that zone. That 2840 level was respected. That also happens to be in our buy zone. Now, this is the euro. This is a market where the majority of patterns are down. Here's how we keep track of that. You can see the majority of patterns are down. So I'm really only interested in sell signals in that market. So why is a market-generated buy signal important to me if I'm only interested in sell signals? Because I know if I get short on, say, a 3-minute chart, and I happen to be short here coming down in that level, I want to know that that's a buy level because I want to be quick to exit my trades, right? Same story here. I may be short all the way down on a 1-minute chart. Markets are fractal in nature. I can use the same triggers, the same tactics, the same everything, the same momentum on the higher time frame, right? I can use all that. Now, if I happen to be short in here, if I'm getting short right here, and I'm short on the way down, I want to know that there's a buy zone here. And if I already know the market respected that buy zone there, I'm going to be awful quick. I'm not going to let a profit run, right? When these moving averages turn up or that MACD turns up, I am out of that short trade. So I may just be in there for a very short amount of time. But nonetheless, I'm more interested in being profitable than I am not, right? So you could be in a short amount of time and still make money. So the bottom line here is I flip back to a 15-minute chart is that the market told me ahead of time that this is a buy zone. So that's market-generated information. The market's telling me there's support there. So I know ahead of time that there is, in fact, support there. There we go. So you have to understand the importance of market-generated information. That's basically all. I don't make a trading decision unless it's based on market-generated information. I'm not making a decision based on what I read, based on what I hear, based on what someone on TV says or something I read. I'm making a decision on what the market did. So everything I do is based on market information. The market categorizes itself. I'm not saying the market's down on this pattern. The market is telling me that it's down on that pattern. You go back 10 days, the pattern's down. 20 days, the pattern's down. 50 days, your day-to-day pattern's down. So when the market's telling me all the patterns are down, I'm just looking for shorts. But I'm also mindful that the market's telling me that there's support. So if I'm short and it's coming up on support, I probably want to take one off and then let one go. And if it doesn't go and it starts turning around, the indicators are telling me it's turning around, I'm out of there, okay? Because the bottom line is you have to make money. We're not putting in all this time because it's fun and it's a hobby. No. You have to make money. At some point, you have to make money or, I don't know, find another hobby, right? So these are two critically important reasons why people fail to not make money, why they don't succeed. because they don't understand risk. It's subconscious. Unless you subconsciously believe that your method is successful, you're not going to be able to consciously take the risks that you need to take. Likewise, if you don't understand that it's the market that is calling the tune and you're just going to dance along to it, if you think you're going to be the one that's determining that to go short because you think that the market's going to go lower, then you're going to lose your money, right? So, two critically important reasons why traders not succeed. And it's nice for me to address this because I don't talk about this when I teach. And if a client starts telling me about some other method or something or a trade that didn't work, I'm kind of cold-blooded. I won't hear it because we have to focus on what does work. Okay, I'm not interested in what doesn't work. I'm only interested in what does work. And in class, we've got students, they're paying for that they're paying to be there, although they certainly don't pay a lot. I understand we're a lot cheaper than most educators, but the bottom line is, we don't have time to sit there and spend on hear some guy talk about how he had another method, right? You got to stay focused. So it's nice to be able to talk about what doesn't work because basically I try to focus on what does work. So if you haven't guessed, I'm big on method. Everything has to be spelled out to the T for me. I absolutely have to have my trading plan in place. I have to follow it. Here, I'll give you an example of our trading plan right here. Well, it's not an example of it. It essentially is it now. We've got it down to where the trading plan is in a flow chart. So that's that. You stick to the flow chart. And actually here, we're getting close to the setup here. So all these conditions need to be in place before we even get to the trade. And guess what sets all these conditions? The market itself, okay? The market itself has to tell me all these things are ready to go before we get to here, and then we start looking for a setup. So the bottom line is I'm big on method, and that method better be spelled out pretty much to the T. There's plenty of times in trading you're going to have to make a decision. You're going to have to, there's some subjectivity to it. But if you can get to where, 90-95% of it is objective, is automated, you're in good shape. That's what the trading plan is going to do for you. That's what your method's going to do. So you must have a robust trading method, and it has to work in all environments. I don't care whether you're in a up market, a mean reverting market, a down market, regardless of the fundamental environment out there, you have to have a method that you subconsciously know is going to be there for you and is going to work for you. And that method better be easily explained. It needs to be simple, and that you need to understand it as being simple. I'm always amazed that generally in the first month or two with us students, they tend to start seeing all these moving parts, and they have a natural tendency to try to overcomplicate it. And that's only natural. The theory for why some sciences work, why does gravity work? It's a pretty simple concept, but once you open up a book and start reading about it, you're like, oh my God, they're complicating this. And I understand that now. It's too easy to do it, but in the end, you need to understand that it's pretty simple. You need to understand what studies your method is based on. If you guys are trading now, you need to understand why does that work, what studies are it based on. For example, our method is based on fractal geometry, which essentially physics really is what it comes down to it. So ours is pretty simple. If I could, before I give it to you in a sentence, let me point out that it has two very important components to it, one a mechanical component and one a behavioral component to it. And you can't get away with all mechanical, and you certainly couldn't get away with all behavioral, right? So you have to combine those. And I think if you're trading today, or if you're considering it, or you're testing a method, or if you're creating your own method, God love you, God help you, right? If you're whatever you're doing in determining what method you're going to use, I think it's best if you combine these two in some way. For us, it's probably 90% mechanical, but it does come down to that behavioral aspect in the second part when you have to trade around news You have to make the decision that you're going to trade multiple contracts, so you're going to manage your first contract different than your second contract, etc. So you want it as mechanized as you can, as objective as you can, but then again, you definitely have that behavioral aspect to it, and that's where the subjectivity comes in. And that's really when you get to be where you're a master. In order to be that master, you've got to understand that there's decisions to be made. One of the students, he's a very good student because he makes me earn it. He makes me earn it. He asks me questions all the time. He's always on the Skype. He doesn't hesitate to call me anytime he has a question. I respect that. I respect people that reach out and get the information they need within reason, right? I mean, he's not calling it on the weekends or anything like that, but no, I respect that. And because of that, he's at the point now where all his questions, before his questions, they were very easy to answer because they were about mechanical components to the method. Now his questions, he's got into that. I know he's learned well because now his questions, the answers now, they're more subjective. I'm saying, well, that's a judgment call. He knows the method enough where he's got the mechanics down pat, and now he's gotten into the behavioral aspect of it. So he's into that subjectivity, so I know he's doing well. Before I define the method, I do just need to point out, so I can keep us on the same page, I don't want to get ahead of you, that this is a huge component of what I do. I understand the patterns on the different time frames, and this is what I was saying in the beginning, how it just amazes me, the fractal nature of markets. Every day it does, because I'm in live markets 4 days a week. I'm highlighting trade setups and signals. I'm on intraday charts. You really need to be able to put the pieces together for people, otherwise they're not going to stay, right? I mean, no one's going to sit to come day to day, come see what you do day in, day out if you don't know what you're doing, right? So this is why I say when I'm just amazed at how this all pieces together, even down on the lower time frames. But this is where it starts. You have to understand that there's different patterns at play in the markets. Okay, and how these patterns are aligned is going to be critical. It's going to be critical in the trading decisions you make, because once I make a trading decision, I do not change my mind. I stick to it. I was joking around. I joke around often. I say, you guys, I must sound like a broken record because I just say the same thing every day. Literally, we're looking at the same side of the market every day. I mean, well, there's a reason for that. Here's dollar yen, if I may. I mean, why would I do anything but be looking to buy dips in dollar yen, right? That's basically, I am a broken record because I know once everything's aligned, that's that. It's the line. So you got to stay with it. So before I define our method, I wanted to point that out, what I'm talking about, that we are taking different slices of the market and we're defining that pattern for that slice. Now I can define what I do. Here's the method. Here's our longer term method in a nutshell. We focus on markets with low non-systemic risk and look to trade at those times when the day-to-day news flow is aligned with the primary or secondary patterns. Break time, here's the euro, and here's, I took a signal on the daily chart. Here's the euro daily chart. And what did I just say? Here, we'll go right back to that. We focus on currency markets, basically, much lower systemic risk than commodities or stocks, right? And we look to trade those markets when the day-to-day news flow is aligned with the primary or secondary patterns. This was the day-to-day zone here. I don't have it marked. Take my word for it. That zone, that purple line, that marked the bottom of the day-to-day zone. So you had a head and shoulders bottom on the zone. So right here, so the day-to-day was already down, and my primary was down. There's my day-to-day. And I should have the primary up there somewhere, if I'm not mistaken. Well, you have to take my word for it. Yeah, I don't see it. The primary was, in fact, down. So the secondary was up, the day-to-day was down, the primary was down. So when I had this shift right here, this is what we call a change of direction candle, and we're going to teach you what change direction is right there. See that big shift right there, that red candle? That's a sell signal on the daily. Now, by the way, that already reached its first objective, so we came out of 2/3 of that position, and we're still short the balance of that position. So that's how quickly it happened. Bam! You take that signal and you're out of it last Friday, and that was based on our exit was based on our risk. Basically, you had 150 pips to risk, so if you get to 1.4 of that, 150 times 1.4, whatever that number gives you, I think it's 220 pips, then you're going to exit a portion of that position there. So we're already out of that position, by the way. But where I was going with this was I was showing you that this signal here is in line with both the day-to-day and the primary. So that's a great example of how we trade longer term. Okay? In line, let me get back to I don't know how you guys keep up with me sometimes. I talk so fast. I apologize. What I was saying is that's a great example of trading when the day-to-day news flow is aligned with the primary or secondary patterns. In that case, the day-to-day pattern was aligned with the primary pattern. No, I never, Philip James, I never go against the trend. I never go against the pattern. I'm patient. I wait for dips to buy and rallies to sell. Pretty simple. No, I'll never go against the pattern. Here's an example. Same thing. The day-to-day shifted in line with the primary. Yeah, that's exactly basically what we did before, but this is a different time frame. And here's examples. Here's dollar-yen. Actually, we don't even need the can chart here. Here's the live chart, and you can see the advantage when you have that day-to-day is aligned with that secondary. And they happen, all three of them are lined up here, the primary, the day-to-day, secondary, but you could see that that's the power of trending markets. And these are just examples of what we mean when we say we look to trade when that day-to-day news flow is aligned with the primary or secondary patterns. And here's how we trade intraday. And this blows my mind that it literally you see the same patterns over and over again the lower you go. We look to trade at those times when the micro patterns are aligned with the day-to-day news flow and trade around the intraday news releases. And here's a classic example of that. The day-to-day was down, so we're just taking these micro. Anytime you get a counter trend line break, that's a micro trend shift. So the micro trend shift in line with the day-to-day, boom, boom. That's the gold market. And it just collapsed. And here's gold recently. People said, oh, you got to buy gold when it collapses, and they all ran in and they bought the gold. And you know what? I'm shocked that sometimes I'm shocked. I shouldn't be. But really, the lack of professionalism that we see in these markets all the time from people that write about them that should know better. Here's the gold market, by the way. And by the way, that day-to-day pattern is still down. Right? So the gold market collapses. So what do? Well, you just draw, very simple, you draw your zone, right? So that's the new zone. Wait till it rallies into that zone. There you see it. There's a nice little head and shoulders in the zone. It could be on it, meaning it could be against it. It could have been below it or in it. In this case, it got in it. Head and shoulders, whack. What does gold do? Collapses. Okay? So that's a perfect example of the method and knowing the power of having those things broken down, breaking the market down on its patterns, and then understanding how to, that it's going to trade in the same direction the majority of the patterns, the majority of the time. All right, sometimes you can't believe that, you have to be so careful what you write about a market because that can influence people, and so you better have a good method behind you if you do that. And I'm shocked at all the stories you read. You got to buy gold. You got to buy gold, and this has been going on for years and years. And what's gold done? It's collapsed pretty good. So I just think I'm a big believer that you need a solid methodology behind you before you do anything. For me, PJ, the news, it's never subjective. Okay, I don't get my news from normal news sources. The day-to-day pattern on the chart is, I understand, is a reflection of the day-to-day news flow. So to me, I don't care what the headlines are saying, what news may or may not be popping out there. The market itself, the pattern in the market is a reflection of what's important to the market. There's no doubt about it. The long-term pattern we see in the market now is a reflection of business cycles. It's a reflection of Fed policy, probably more than anything. But no doubt about it, the pattern you see on the chart will be a reflection of what's important to a market, the news that's important. Okay, so there's some news you can run that. You know, what's that blog that he constantly posts negative stories. Zero Hedge. I mean, Zero Hedge can post all the negative stories he wants. He can go find every negative story, you know, and keep on publishing it, but the market's not listening to him. So to me, news is not subjective. To me, news is very objective. It's whatever pattern you see on the chart is a reflection of the news that the market takes seriously. So again, everything we do is market. The market tells us what to do. Literally, if the market's ignoring the news, then I'm going to ignore the news. So I just go along with what the market says. So to me, PJ, Philip James is saying about news then not align. It had to have been. There's no other way. Otherwise, the market would not have done what it did. Markets are not going to go against influential news. I mean, that's just how it is. So again, to me, the day-to-day pattern is it's as objective as anything else we do. And here's a great example of that in the Australian dollar. When the day-to-day pattern's down, you're going to take these micro shifts. Basically, that's what we're highlighting to you, the power of that day-to-day pattern. When we just look for the micro patterns to shift in line with that day-to-day news flow. And the day-to-day news flow is reflected in the day-to-day pattern. So when that day-to-day pattern's down, you're just looking for those micro shifts in line with it. So, you know, the news is your friend, really, once you understand that, you know, once you fully get it, that the day-to-day pattern, whatever pattern you see on the chart, is absolutely a reflection of the influential news flow. There's all kinds of news out there, but is it influential or not? That's the key. The market will determine that for you. And this is a statement that just absolutely hit me as being, it hit me. I knew intuitively that this man was spot on. Bill Williams, great guy. Now, his method may be a little too risky for me, but the premise that you have to have a method built on fractal geometry, built on nonlinear dynamics, it hit me like it was a truism. I just knew right away that was the way to go, and because of that, I am part of that first generation using effective nonlinear chaotic techniques. And the quote is, in this early part of the 21st century, we have a choice to either be a part of the last generation of traders and investors using linear, ineffective techniques, or the first generation using effective, nonlinear, chaotic techniques. Okay, bottom line, essentially chaos is physics, really. I mean, that's really what it comes down to. And that's what scientists are discovering now also, that fractal geometry is based on physics, like everything else in this world, beyond and above and below, right? So this really hit me, and no more has it hit me than recently. We've had people, hey, they come and they say, let's automate some of what you do, and I say that's great. And they say, okay, well, how do you do it? And I tell them what I'm doing. They go, well, we don't have a tool for that. And I'm shocked that it's just basically some of the simple techniques that we use. And these are people that they've got they spend huge money on the computer software and all that stuff, and they can't take some of the basic things we do and have a computer replicate that. So I'm actually very proud of that. That goes back to this quote though, because the computers are based on linear logic, right? They're not based on nonlinear chaotic techniques. So you make the choice. The choice is yours. Or if you don't, you can, again, you'll be part of the last generation using ineffective techniques. And this headline quantifies that for us, right? To use their word, London quant hedge funds report second year of losses. So you're either going to go along with where the market wants to go, you're either going to ride along with where the market wants to take you, or you're going to lose. Pretty simple. So, it comes back to method. I define trading chaos as employing a method based on fractal geometry and embracing the understanding that markets are scalable and these scaled patterns are repetitive. That's the secret to trading right there. Markets are scalable and these scaled patterns are repetitive. How else do you think I have the confidence to be short here yet know I'm in a potential buy zone? Same story here. I'm all the way down. This is a 15-minute chart. I knew that this pattern shifted bullish when it eclipsed these levels. Therefore, I'm going to be real careful when I'm short here. I can still short it because everything's scalable. Here I'm on a 3-minute chart. I'm not afraid on this 3-minute chart to take that sell signal right there, to take that sell signal right there. But I know that I've got a bullish zone. That's a bullish pattern. Let me go back to the 15-minute. The secret to trading is no doubt that the markets are scalable and that those scale patterns are repetitive. Here you see that repetition. I'll take that trade, I'll take that trade. But I know that I'm getting into support. Why do I know that? Because the markets are scalable and these patterns are repetitive. It does the same thing over and over again. That's the secret right there. Markets are scalable and those scale patterns are repetitive. A lot of traders, they think they're looking for these one-off events like they're looking for an anomaly in the markets. Well, I don't look for anomalies. I look for what happens every day over and over again. Stefan, but humans trade and programming computers, so I think it's not, well, that is the psychic understanding of our case. Oh, no problem. Oh, you're doing very well, considering English is not your first language. I don't want to get into the theory of it, but yeah, they're making those. They're making the changes now. Anyone can make the change, can make the computer do, track the different patterns once they know how to keep track of the different patterns. It's easily doable, and it will come down to that too. Currently, this is shocking to me, every single indicator, and this is eSignal program, by the way, very, very good program, but every single indicator on here is based on direction. There's no indicator you can just hit the button and it'll give you a pattern, unless you build it yourself. Every single indicator on here, the myriad of studies that you can have here, they're all based on direction. None are based on pattern yet. It'll get to that, though. It'll get to that. I certainly don't mind if it takes its time. PJ, that's not true. No, that's not true. Bill, so does Bill Williams not? No, Bill Williams uses moving averages. Bill's doing great, by the way. I talked to him a couple weeks ago. He's not a young man anymore. We joke around. He's not a young man anymore, but he's doing pretty good. He's 82 years old, I believe. Bill Williams. So I better move along. I'll run out of time. Embrace that understanding that markets are scalable and that those scale patterns are repetitive. Well, this is risk tolerance threshold theory. I don't think we need to get into that. We don't have time to get into that. Really, this is what you came for. How can we help to improve your trade selection? We're going to take a page from our mechanical framework and how we determine pattern and direction. Really, you only want to trade when direction is aligned with pattern, right? So know when direction is aligned with price pattern. So you need to know how to define direction, and that's what we're going to show you today, how to define direction. It's not really that direction. It's essentially a change of direction. Because if I'm telling you that direction is now up, then I need to go back and show you when direction changed from down to up. And I need to define that in such a way where you know yourself every time direction changes, right? Jeffrey, no, that's eSignal. eSignal, it's eSignal on demand for currencies is about $50 a month. Yeah, $50 a month. JP, how does fractal? Here, let me go back. Here's how I define a fractal, because this is a very important point. That's a great question, JP. Where are you from, JP? I was going to guess where you're from, but I'll that would just be a guess. That would be kind of ignorant on my part, so I'd rather just ask you. India. Oh, very good, very good. Here, let me keep track of my slides here. I'm going to just go back and show JP. This is how I define a fractal. Each one of these patterns is a fractal to me. Okay, we call it a micro pattern. It's a fractal. That my 10-day fractal, my 20-day fractal, my day-to-day fractal. So a fractal is a pattern. A fractal, by the way, is just a pattern that when you add it all up, the sum of the parts equals the whole. Right? Your hand is a fractal. Your arm is a fractal. Your hand is a subset of your arm, which is a fractal. But this is how I define fractals. Okay, the fractal is a pattern in the market. So thank you for asking that. And that validates why I put that slide in there where I did. Right? Now I understand this is a lot to get. Basically, you're forced to take my word on everything. Right? So I'm glad that you guys ask a lot of questions. Okay, but here's what we're going to teach you today. Know when direction is aligned with price pattern. It's, as I said, it's not the direction, it's the change of direction we're interested in. It's because we need that defined so we not only we can go back and see what happened after direction changed, but then we can go go forward and know when a direction is taking place. I lost my. Philip James, is an A, B, C, D pattern a fractal? Yeah, any pattern is a fractal. Your finger's a fractal. You yourself as an individual are a fractal. You're a fractal of your subset of, people your age that live where you live and make the same amount of money you make. You're a fractal. The sum of the parts equals the whole, right? So change of direction, I'm going to define this, is a trend line break plus a directional line shift. I'm sure, PJ, I'm sure. Change direction equals a trend line break plus a directional line shift, okay? You all know what a trend line break is, right? You need to know what a directional line shift is. So directional line defined as the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend, okay? Very, very important. You want to write this down. The low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. I should mark this as red, maybe. Yeah, the low of the highest closing candle in an uptrend or the high of the lowest closing candle in a downtrend. And we're going to show you how we use that. Directional line is used if price is closing below the direction line, direction is down. If price is closing above the direction line, direction is up. Here, I'll go to a euro chart. Man, where's my daily chart? Well, I'll have to borrow one. Remember, I said the low of the highest closing candle in an uptrend. Okay, the highest closing candle in an uptrend right there. So the low, I'll put a white line on there. That's the low of the highest closing candle in an uptrend, right there. Okay, that's the low of the highest closing candle. Now, before that was the highest closing candle. This was, and this was, and this was, right? Then here was, that was the low of the highest closing candle. Right there, you actually changed direction. You closed below the low of the highest closing candle. You changed direction. However, the pattern was bullish, so you're not interested in that. You changed direction back higher here. At one point, that was the high of the lowest closing candle, right? See that little doji in there? At the time, that was the lowest closing candle. So this market changed direction back higher. So that now you're interested in that. You're interested in this bullish change of direction because it's in line with the pattern. Okay? every time you get a new high close, you got to move that line up. First it was here, then it was there. See? It's right there. Then it was right there. Then it was right here. Then there. Then there it changed. Now, that's interesting that you change direction. You could take that as a signal to exit a long trade, but it's really not that significant because the pattern is still bullish. Okay? Now we're marking, first we're marking the low of the high closing candle. Once you close beyond it, now we go from marking the high of the new low closing candle. Now the line's going to move down. Every time we get a new low close, you're going to mark the high of that low close. Okay? And there, then there, then there, then there, then there. So you're just essentially, you're just moving on. So that's direction. Very handy to know what direction is. Oh, I lost that chart, son of a gun. There it is. Very handy to know direction, but it's only significant if it's in line with the pattern. So that's how we use it. If price is closing below the direction line, direction is down. If price is closing above the direction line, direction is up. Yes, JP, that works on all charts, all time frames. It's a pretty good trigger. It's only effective if it's in line with the pattern, though. And here's an example of it. That's the highest closing candle, and we're always looking for that we define a reversal, or what we call a change of direction, as a trend line shift plus a directional line shift. You close below the low of the highest closing candle and the trend line, pattern shift, right? Reversal. Close above the high of the lowest closing candle in a downtrend, that's a reversal. Now, it's only effective if it's in line with the pattern. It's just a signal, okay? I've given you enough information now to go put a rope around your neck and jump off a cliff, basically, okay? Because it's just a trigger. You got to use it in the context of the overall method. Okay, so again, I got to caution you. That's why we say, trading involves risk of loss. So you don't want to go run right out and take every change of direction. You'll catch some big trades if you have the discipline to let a profit run, but you'll also take a lot of little losers along the way too. But the key is, remember this. Taking that change of direction signal when it's in line with the pattern. That's key. Okay? Price pattern, pretty easy to figure out, right? I haven't changed this chart in a year. I don't need to. It's the same pattern. Euro went down to 120, came up to 137. Now it's just below 130, right? It went down, it went up, it came back down. It stayed in the pattern hasn't changed. So the grand pattern, the long-term pattern, the euro hasn't changed in a year. Okay? Patterns don't change. I love the pattern because you just stay on that one side. You're either buying dips or you're buying breakouts, or you're selling rallies or you're selling breakdowns. Momentum trades. Basically, you're either buying a dip or you're trading momentum. Pretty simple. Here's another pattern. I don't have to change the pattern. Patterns are cool though because this is a two-way mechanism, by the way. You'll see the lower time frames lend some predictability to what happens on the higher time frames, and the higher time frames mimic what happens on the lower time frames. So it's a two-way mechanism pattern. But really, when it comes down to it, how you make money? Buy dips and uptrends. This is an uptrend, buy the dip. Here's the uptrend is even more mature, buy the dip. So we're always looking to buy dips and uptrends, sell rallies and downtrends. Pretty simple stuff. We use that pattern as a trend map. If all the patterns are up there, then you're going to go long, right? You're going to buy the dip. If they're all down, then you're going to sell the rally, right? In that case, back when the euro was bullish, you had the majority of patterns higher, you're buying dips. You're just looking for buy zones. So pretty simple stuff. Scalability and repetition. This is the secret to trading. Know when direction shifts in line with the pattern and look for it to repeat itself over and over and over again. That's how discretionary traders enrich themselves at the expense of others who they're just not experienced. They don't understand risk. They've never experienced letting profits run consistently, so they're not that good at that. In order to get good at something, it takes what? Repetition. Markets are the same way. So we need to be as repetitious as the markets are, right? And here's just an example. Again, scalability. You see the same actions on the higher time frames as the lower time frames. This happens to be the highest closing candle, right? See this uptick, this rally last year or 2 years ago? That's the high. That's the low of the highest closing candle. Once you break down below the low of the highest closing candle and the trend line, you change direction. That's a sell signal. Same story here. That's the little uptick there. That's the highest closing candle right there. That's the low of the highest closing candle. You close below it. That and the trend line, that's a sell signal. And what happened? The market dropped down to 120 back then. So it happens on the higher time frames, and it happens on the lower time frames. It's the same mechanics, the same signal we use, period. It's just, you can take advantage of it. It's scalable, basically. It's fractal in nature, that you can break it down and you can use it on any time frame. And that's truly the beauty of trading, and that's why I teach in live markets. It's really easy once you understand that. Well, I should say simple. It's never easy because it's very simple until you start risking your money, and then you know what happens. We all act like a 12-year-old kid the first time a cute girl looks at him, right? That's how money's a funny thing. Money makes us stupid. If you haven't realized that. You'll have a big leg up anytime you have a handful of dollars, just give it to your wife or give it to your kid or give it to your parents or something like that, because money is going to get you in trouble, right? That's why so many people lose at trading, because it's the lure of the money. They don't think straight when it comes to money. So be aware of that. But in hindsight, it's all very, very simple. Yeah, there's no doubt about it, Diana. You know it. Money makes us stupid. It's true. It really is true. Imagine a 12-year-old little boy the first time a cute girl looks at him. Okay, that's how we all are with money. Okay, it's just how it is. So you have to have that mindset ahead of time that money is silly, and then you're going to be in a lot better shape. So, hey, always a pleasure to be with you. If you're interested in what we do at Trading University, we'd love to come. You can come and see us. Here, I'll pull up the site. I'll show you how you can come and see us do a free tutorial with us. We'd love to see you do that. We'll demonstrate how we trade these setups and signals on the lower time frames. And we demonstrate it on the higher time frames too, but it's a lot easier to demonstrate on the lower time frames because we want something to happen in the time we're together. So that's why I use those lower time frames. And here's the new site, trading-u.com. Come and see what we're doing. Go to courses, live market analysis, trial, and you could sign up for a trial there and come see us perform in live markets. That's trading-u.com. And we're very proud of what we do there. We're pretty unique in the industry, and that basically it's a per month basis, but you get access to everything your first month. You get access to the master's course, the archives, the graduate, the advanced concepts. You get everything up front, including one-on-one mentoring for that $199 a month. Or if you're in a bigger hurry, you can actually get access to, you don't get the one-on-one mentoring, you don't get the Skype chat group, but if you open an account with Forex.com or FXCM, you can get the program for free at EOS Trade. So, hey, thank you so much. If you have any questions, there's my info. Or here we go, info. There we go, we add that one in. Thank you so much. Always a pleasure. Oh, Stefan had a question. That's right, Phil James. You're no longer a threat to them. Right. I have tons of gray hair. I can walk around. I can say things, and girls just laugh at me. He's funny because I'm harmless. I'm an old gray-haired old man. It doesn't matter now. I've accepted this. Okay. Stefan says, okay, after you say chaos, I was a little confused. Fine, Kath. Yeah, we used to show Mandelbrot's generator. The generator is that's a fractal. Yeah, markets are definitely fractal in nature. Well, Philip, James, you were certainly excited today. It's good to have you. Good to see anyone asking questions is a good thing. Yeah, so let me know if you guys, if you do want to take advantage of the EOS trade offer, just send us an email so we know that you're out there. Otherwise, we don't know to get you hooked up to the campus. And there's the website, trading-q.com. Here it is. Okay, thank you so much, and we'll catch up with you guys next week then. Always a pleasure.